So the market cycle is just these general waves, if you will. We know if we backed up and saw the market for the last 50 years, that the markets, what does it average? 9–10% a year. This is through the bad times, the good times. Dividends make that maybe a little bit more. But a 50-year thing, the market is higher today than 50 years ago. I mean, so generally, because really what the market represents is, intuition, execution, making products better and safer, and then the price goes down, it gets cheaper, there's innovation, there's the internet that comes along, there's Amazon that comes along, and things just freaking grow over time. And the ones that don't execute and don't have innovation, they can quietly bow out. We're talking about the 40 car makers, and now it's whittled down to the ones that we know. Ford survived, and Toyota came along, and it plugged in, and GM, and so forth. So, but all along, the market flows in cycles. And it was Bill O'Neill, the IBD founder, who studied markets for decades and determined and uncovered that about 3 out of 4 stocks travel the way of the overall market cycle. And so, if you've ever dabbled or tried trading in the market in the past, maybe you bought some call options or stock, and it just, you maybe and you made money, and like, oh my gosh, this is, I want to do this all the time. I mean, I can't lose. And well, you might have been doing that in a market cycle that maybe just started. And 3 out of the 4 stocks go with the overall market cycle. And it just seems like that, in those market cycles, bad news doesn't really seem that bad, and good news is really, really responded to, but that most stocks are moving in a direction. But if you happen to start here, maybe caught it after the market cycle peaked, and we're trying to buy things, well, the market cycle's dragging 3 out of 4 stocks with it. This is traditionally just overall what the market cycle is and why you want to know about it. And we'll check out what this article says. So we come back over. E ratings for stock indexes, but here's the here's the grades Bill O'Neill decided to put on it. He decided to grade the market cycles from A to E. And so that would mean there's a B, there's a C, and a D, and an E. And A and B represent accumulation. Accumulation. C is neutral, and D and E is distribution. And so IBD came up with their A, accumulation, distribution, grading. So that's not A through D. This is accumulation and distribution. Where is it and what is it and where has it been? And I've always talked about looking out for a 2-grade move in this grade, grading of the market. And specifically when we're talking about the market, there's 2 main ones that we look for. It's the S&P 500 and the NASDAQ. Could you do the Dow? Yeah, but the Dow's only 30 stocks. They have an industrial leaning. I mean, what does that matter in 2019? Of course it matters, but in the course of our world today, it's software innovation with the cloud and how you're able to deliver and execute and outsell. I mean, that's not an industrial. Okay, is it important to know the industrials? Well, sure. But aluminum, Alcoa, yes, it's a big deal, but the S&P 500 and the NASDAQ are way more broad and representative of what the market is. And so with all that said, check this out. E ratings for stock indexes. I'm just going to read this. We're going to read it together. Another technical item that recently came into play is IBD's accumulation distribution rating. Going into Thursday's session, the rating was E on all three major indexes, the NASDAQ, S&P 500, and then the Dow. The NASDAQ and S&P are what we want to pay attention to. An E rating points to heavy selling, but it has an upside. I mean, it goes to E. Can it go to F? No, it's at E. Research shows that follow-through days that occur when the market is showing an E rating often work. So meaning we're kind of skidding across the bottom. Is it taking all stocks with it? No. But the market cycle takes, on average and traditionally, 3 out of 4 names with them.